So I was looking at the calendar this morning. It is January 24th, 2026, and we are officially settling into the new year.
Yep.
The holidays are over, decorations are down, and usually right about now we get those big, State of the Union style economic pep talks.
Right. The new year, new me energy.
Right.
But for the global economy.
Exactly.
Yeah.
And looking at the headlines coming out of Beijing this week, you'd think that's exactly the vibe. They just put out the full year economic data for 2025, and the headline number, the GDP growth, is sitting at a pretty comfortable 5%.
Neat and tidy.
It is. It hits the government's target perfectly.
Yeah.
So mission accomplished.
Well, on the surface, sure. It looks great on a billboard. But you sent me this stack of transcripts and reports from the One Belt, One Road Observation channel.
Yeah.
And specifically a series they're calling China Economic Mud. And I have to say, the mood in these documents is definitely not mission accomplished.
Economic mud. That's a very visceral title. It doesn't exactly scream high-speed growth.
No, it doesn't. And that's really why we're doing this deep dive. Because the headline says 5% growth, but the source material implies we are watching this massive structural shift that completely contradicts that stability.
A structural shift.
They're basically arguing that the killer app of the Chinese economy, the one mechanism they've used for 30 years to guarantee growth, hasn't just stopped working, it's actually broken.
Okay, when you say killer app, or the key called the economic stabilizer, we're talking about a specific metric here.
We are. We are talking about fixed asset investment, FAI.
Okay, FAI. Now, I know that sounds like something only an accountant would get excited about. Fixed asset investment sounds so dry. But in China, this isn't just another line item, is it?
No, not at all. Think of it as the engine room. For decades, FAI has been this brute force engine that drives the Chinese economy. I mean, we're talking about building bridges, high-speed rails, skyscrapers, massive apartment complexes, factories. Whenever the global economy got rocky, like 2008 or during the pandemic, Beijing would just rev up this engine, pour concrete, and the GDP numbers would go up.
It's the cheat code. If consumers aren't buying phones and exports are down, you just go and build a new subway system.
Precisely. And structurally, it's a huge piece of their economy, something like 25% to 30% of the entire GDP. So when this engine isn't just idling, but actually goes into reverse, it acts as this massive drag on the whole system.
And that's what the data is showing.
The data released on January 19th shows exactly that. The engine is sputtering.
So let's get into the numbers. It's January 2026.
Yeah.
The National Bureau of Statistics drops a report. How bad is it really?
It's historic. Let's look at the headline number first. For the full year of 2025, fixed asset investment, and this is excluding rural households, it totaled roughly 48.52 trillion yuan.
Which is just a big number on its own.
It is, yeah. But the shock comes when you look at the year-over-year change. It dropped by 3.8%.
Minus 3.8%. Okay, let me play devil's advocate for a second. 3.8% doesn't sound like a complete catastrophe. It sounds more like a mild dip. Why is the source material treating this like a siren going off?
Because you have to understand the baseline. I mean, China is an economy that's built on high-speed expansion. For 30 years, this number has almost always been positive, usually double digits.
Double digits, right.
So a drop of 3.8% is just, it's massive. And here's the kicker. The market was already pessimistic, right? They were expecting a drop of maybe 3%. So this came in significantly worse than the already gloomy expectations.
So it missed the mark, but on the downside.
Significantly. And what's even more concerning to the analysts at One Belt, One Road Observation is the trend line throughout the year. If you look at the data from January to November of 2025, the drop was 2.6%.
Okay, so for the first 11 months, down 2.6%, but the full year finished it down 3.8%. That implies something.
It implies that December was a disaster. The decline didn't stabilize at the end of the year. It actually accelerated. It basically fell off a cliff right as the year closed out. Wow.
And a 1% drop in FAI, it generally pulls total GDP down by about 0.3% to 0.5%. So a nearly 4% drop. That is a very heavy anchor tied to the economy's ankle.
Which makes that 5% GDP growth headline seem even more mysterious. But before we get to the how, I want to understand the where. If this investment is vanishing, where is it disappearing from? Is this just the housing crisis?
That is certainly the main culprit. The real estate sector is in absolute freefall. In 2025, real estate investment dropped by a staggering 17.2%.
Oh, 17.2%. That's nearly a fifth of the entire sector just
Yep.
Gone in 1 year.
And context is key here. It's not like 2024 was some banner year. In 2024, it dropped by 10.6%.
But it's getting worse.
Exactly. Much like the overall number, this isn't bottoming out. It's accelerating downward. The collapse is gaining speed.
Okay, so housing is the big hole in the bucket. We've known about the property crisis for a while, Evergrande, Country Garden, all that. But the usual Chinese playbook is pretty standard. If housing is down, the government steps in and builds infrastructure to compensate.
More roads, more pipelines. Yeah, more 5G towers. Did that happen in 2025?
And that's the trap. This is where the source material gets really interesting and, frankly, a bit scary. You would expect infrastructure investment to go up to save the day.
That's a classic move.
It is. But in 2025, infrastructure investment actually fell by 2.2%.
Wait. Infrastructure investment fell while the economy was struggling. That seems completely counterintuitive. Why wouldn't they just, print money and pave a road to nowhere if it keeps the numbers up?
Because they can't afford to. And this connects back to a specific mechanism called land finance. This is crucial to understanding why the whole system is jamming up.
Land finance. Okay, unpack that for us. How does that work?
So think about how your local city gets money. Usually it's from property taxes, right? You own a house, you pay the city every year.
Right.
In China, there is no recurring annual property tax for homeowners. So instead, the local government owns all the land. And to raise money to build that new subway or that park, the local government sells a 70-year lease on a plot of land to a developer.
And they get a huge lump sum of cash up front.
A massive sum. So the city is basically the landlord, and they need these new tenants, the developers, to pay a huge deposit to fund the city's budget.
It's a beautiful cycle, I guess, as long as it keeps working.
Exactly. As long as housing prices go up, developers are desperate for land. They bid the prices up, the local government gets rich, and they use that cash to build all these massive infrastructure projects.
And that makes the land more valuable.
Right, so developers pay even more next time. It feeds on itself.
But if the developers stop buying,
The cycle breaks, and that is exactly what happened in 2025. We just said the real estate market is down 17.2%. Developers are just trying to survive. They aren't buying new land.
so the revenue stream for the local governments it dried up.
It didn't just dry up, it evaporated.
Oh.
Without land sales, the local governments are broke. They literally cannot afford to turn on the machines to build the infrastructure.
Wow. So it's a double whammy. The housing market crashes, which is bad. But because of this land finance addiction, the housing crash basically ties the government's hands behind its back.
Exactly.
They can't stimulate the economy because their wallet was tied to the very thing that crashed.
Precisely. It turns the stabilizer into an anchor. They want to build, but they can't pay for it. That 2.2% drop in infrastructure isn't some kind of policy choice. It's a forced error. They just ran out of gas.
That is deeply worrying. Because if you lose both real estate and infrastructure, what do you have left? I mean, is there any good news in this report? What about factories, tech? We hear all the time about Chinese EVs and solar panels taking over the world.
The government is trying very hard to highlight that. They point to manufacturing investment, which did grow, but it only grew by 0.6%.
0.6%. That's it. That's barely a rounding error.
Especially when you compare it to the historical average for manufacturing, which is usually around 5% or 6% growth. So yes, it's positive, but it is meager. And just on a purely mathematical level, the manufacturing sector isn't nearly big enough to offset the massive black hole created by the collapse in property and infrastructure.
It feels like trying to put out a house fire with a water pistol.
That's a very fair analogy, and it becomes even starker when you zoom out. The analysts from the One Belt One Road Observation Channel really emphasize that we need to look at the 5-year trend to see that this isn't just a bad year, it's a structural break.
Okay, let's walk through that timeline. Take us back to 2021.
Okay, 2021, post-pandemic recovery phase. FAI grew by 4.9%. Healthy, solid. The engine was humming along.
Yep.
Then 2022, we had a lot of policy stimulus, so it ticked up to 5.1%.
So good. The train is moving.
Then comes 2023, the engine starts to sputter, growth drops to 3.0%. Then 2024, it's barely holding on at 3.2%. You can see the momentum just fading.
The revs are dropping.
And then 2025,
The plunge.
the plunge, minus 3.8%. We've moved from a positive growth trend directly into what the source calls a structural cliff. This isn't a cycle where things go up and down. This signals that the old playbook using investment to save the economy is fundamentally broken. The trend line has just snapped.
That visual of a cliff is pretty terrifying if you're a business owner or an investor. Speaking of which, who is actually feeling this? Percentages are abstract. This has to be hitting real businesses.
It absolutely is, and the data on private investment proves it. Private investment dropped by 6.4%.
6.4%. That's almost double the overall decline.
Exactly, and private investment is the clearest proxy we have for confidence. I mean, state-owned enterprises might invest because Beijing tells them to, but private money runs away when it's scared, and right now it is terrified.
Because they just don't see a return.
They don't see a return, and they don't see a future. The source describes a feedback loop, a vicious cycle. It starts with investment dropping.
Yeah.
When investment drops, jobs disappear. When jobs disappear, consumption weakens because people have no money. And when consumption weakens, businesses sell less, confidence falls even further.
And investment drops even more.
You're right back at the start.
I want to zoom in on who actually feels this. Because when we say fixed asset investment dropped, that sounds like a spreadsheet problem, like something a banker in Shanghai worries about. But this affects real people on the ground.
It does, and the report is actually really good at grounding this. It lists out the victims of this crash, and it's a long list. It starts at the bottom of the pyramid, the excavator drivers, the guys who mix the cement,
Right.
the migrant workers who come from rural villages to the big cities specifically to work on these sites.
The sponge for labor.
That's it. For decades, construction was the sponge. If you couldn't find a job in a factory, you could always go pour concrete. That sponge is dry. The report mentions wage arrears becoming a massive issue again.
Which is just a polite way of saying wage theft.
Basically, you work for 6 months, the project runs out of money because the developer can't sell the units, the developer vanishes, and you're left standing outside a half-finished building with no pay.
And it's not just the laborers, is it? The report also mentioned the small bosses.
Yeah, the supply chain. I mean, think about the guy who owns a small business that supplies windows, or the lady who runs a company that rents out scaffolding.
They operate on thin margins.
Very thin. They front the cost of materials, expecting to get paid when the building is finished.
But if the building becomes what did the source call it, a rotten-tailed building?
Then they go bankrupt. The source material uses that specific term, rotten tail buildings, and it's these concrete skeletons that dot the landscape now. They aren't just eyesores, they're financial black holes that have swallowed the savings of families who bought the apartments and the livelihoods of the small business owners who supplied the materials.
That's a heavy image. A structural cliff isn't just a line on a chart. It's a half-finished building with no one working on it, and a scaffolding company going out of business.
And that just feeds into the confidence crisis we talked about.
Yeah.
If you walk past a rotten tail building every day on your way to work, are you going to go out and spend money on a new car?
No way. You're going to save every penny you have.
And there's your deflationary spiral. And this isn't just a rural thing either. The source noted that even powerhouse cities like Shenzhen are seeing investment data that is even worse than the national average.
Shenzhen, the Silicon Valley of hardware. If they're struggling, that's a huge red flag.
It is. It shows that even the most dynamic, tech-forward parts of the economy are not immune to this investment freeze.
Okay, so we've established the engine is broken, the driver is broke, and the passengers are scared. But I want to circle back to the very beginning. The government announced 5% GDP growth for 2025.
How?
The logic gap.
Yeah. If investment, 30% of the economy, is down nearly 4%, where is that 5% growth coming from? Is it just magic?
The source spends a good amount of time on this contradiction. The official explanation would probably rely on exports and industrial production, selling things to the rest of the world. But the source is skeptical.
Highly skeptical. They argue that while exports might be holding up, they can't possibly be doing enough heavy lifting to counteract a massive contraction in investment and weak consumption. There's a disconnect.
It feels like two different stories are running in parallel. The official story is structural optimization. We're getting rid of the bad investment to make room for high tech.
Right. The cleaning house narrative. We meant to do this. We are pivoting to new quality productive forces. But the source's view is economic stall.
A stall.
They argue that the bad investment real estate and infrastructure is dropping way too fast for the new investment high-tech manufacturing to replace it. It's not a transition. It's a vacuum.
It's like tearing down your old house before you've even built the new one, and now you're sleeping in the rain.
And claiming it's part of a lifestyle optimization plan.
Exactly. I'm just embracing nature. So where does this leave us for the rest of 2026? The report came out in January. What's the forecast?
It's grim. The source predicts this negative trend is going to continue. Investment has a long lead time. Projects stopped today affect the economy for years to come. They predict this could drag the 2026 GDP below 4%.
Below 4%. That would be a huge psychological blow for a country that used to hit 8%, 10%. 4% feels like a recession.
And potentially lower. The big concern is the unemployment pool we touched on. Construction and infrastructure used to be the safety net for employment. That net is gone, and those jobs are not coming back.
And if those jobs aren't coming back and factories are investing less, we're looking at a serious long-term problem.
The source calls it a long-term quagmire, unless there are drastic reforms. But the problem is the government is constrained. They can't borrow their way out because of the debt, and they can't build their way out because there's no demand for more houses.
So the stabilizer has failed. The old reliable trick doesn't work anymore.
It has failed.
Yeah.
And the transition to whatever comes next, whether it's consumption-based or high-tech, is proving to be incredibly painful and much, much slower than anyone anticipated.
It really makes you rethink how we look at economic headlines. We see 5% growth and just think business as usual. But if you ignore these investment stats, you're missing the real story.
That's the key takeaway here. GDP is a composite number. It can hide a lot of sins. But fixed asset investment, that's hard cash being spent on the future. And right now, China is spending less on its future than it has in a very long time.
That is a sobering thought. If you stop investing in the future, eventually the future arrives, and you're not ready for it.
Precisely. And that raises the most provocative question, really, for our listeners to chew on. If the Chinese government can no longer build its way out of a slowdown, what is Plan B?
The sources suggest there might not be one, or at least not one that doesn't involve a lot of pain.
It seems the only path forward is massive structural reform, taxing property, boosting consumption, but those carry huge political risks. So we're kind of in this holding pattern, watching the engine stall, waiting to see if anyone knows how to restart it without the old keys.
A structural cliff, a broken engine, and a missing Plan B. It's going to be a fascinating and likely turbulent year to watch the data. Don't just read the headlines, folks. Watch the investment numbers.
Absolutely. The devil is always in the details, or in this case, in the falling fixed asset investment.
That's a wrap for this deep dive into the Chinese economy's bumpy start to 2026. Thanks for listening, and we'll catch you on the next one.